CoreData has a global perspective. We can see what's happening internationally, and what's particularly interesting is what's happening in the UK. So we'll have a look at what's happening in the UK, and would love to invite you to ask questions of me as we run through. It's my hypothesis that every good idea and every challenge facing the financial services industry can be viewed and better understood through the lens of 1980s popular culture. So what we have here is Robert Palmer, his 1980 song, Looking for Clues, trying to understand what's happening. And there are four big ideas that I would like to talk about in the next 20 minutes. First is a matter of trust, probably recognise that, Billy Joel, 1985 song. We'll have a look at what's happened with trust in Australia, and particularly with financial advice. Take a look at the UK experience over the last 6 or 7 years. Since the Retail Distribution Review, the RDR, which can be simplistically likened to the challenges we are going through with the FSC education standards and what we went through several years ago with the future of financial advice. Then CRI freedom, looking at the dispersion of the financial advisors around Australia and how they are regrouping, and how do we make sense of that? How do we make sense of that as licensees, as advisors, and as fund managers seeking to reach the right people at the right time? Okay, before we get into it, CoreData has, over the last several years, done loads of research on the value of advice. And just to be clear, the value of advice is extraordinary. We know that everyday people who access and implement quality advice, it improves their lives. They are wealthier, they can spend more, and they can do more. So the numbers add up, but the benefits go far greater than that. They go far further than just the numbers. The sense of confidence, the sense of optimism, the sense of control that everyday people get from advice is clear and measurable. And the fact that we are seeing increased demand, no question, increased demand from Australians for advice at the same time that we are facing potentially a crisis of supply is problematic, and it needs to be solved. Okay. There's a lot happening in this slide. CoreData has, since the start of the Royal Commission, dipped into everyday consumers every quarter and asked them a very simple question around trust. On a scale of 0 to 10, an 11-point scale, on a scale of 0 to 10, how much do you trust particular industries, professions, even brands? Let's just focus on financial advice there, and you can see there grey is earlier, so that's Q1 2018, before the Royal Commission hearings. You can see there that trust, as measured in that 11-point scale where the score is 6 or greater, so mild trust or to strong trust, was 60%, but that fell and has fallen and has not recovered. You can see it's not just an issue for financial advice. So just to be clear there has been a degradation in trust in the financial advice system. As the previous panel talked about, if you ask an advised client with an active relationship with a financial advisor what they think of financial advice, the answer is very different. 90% of advisors are willing to recommend, of clients of advisors are willing to recommend their advisor to family and friends. But the question is, how do we reach the unadvised? Looking to the UK, some measurable facts here. With the introduction of the RDR at the end of 2012, there's no question that advisors are better educated. That's not so much a function of advisors increasing their knowledge. It's more that those who are uneducated left. And we did see advisors drop 18 to 20% during that period. They are recovering. Data here says 2021. Wouldn't be surprised when we get some fresh data that advisor numbers will have returned to their previous highs. Quality is up. The regulator loves to see that. That's as measured by complaints. Interestingly, fees are up. We'll take a look at fees. But another finding, despite lots of hope and wishing and praying, robo-advice has failed to resonate with the market, and it is clear it can get confusing because the numbers are so big in the UK and the US. But when you have a look at penetration and what the demand is, it has failed to resonate, and the answer goes beyond direct interaction with consumers. There needs to be an advisor in the mix, at least somewhere there. This interactive chart shows the shift in the split between fee revenue and investment commission revenue for financial advice practices. So before RDR, it was an industry heavily reliant, and it's going to go again because I've been speaking too slowly, is an industry heavily reliant on investment commissions. That changed with the investment commissions being banned. But it did take several years and actually still hasn't worked its way through the system. We expect it to take about a decade for the commissions to work their way out of the system. Interestingly here, though, it's been more of a replacement. There's a message here for financial advisors and licensees to embrace the new world. So how you read this, earlier is at the top of the slide, later is 2017. The dark blue bar is revenue from investments. So let's just focus on that. And you can see there around the time of RDR 2012, advice revenue, practice revenue coming from investment advice was pretty flat. But once people got their heads around it, it more than replaced the commissions. You can see there that revenues are significantly higher today than they were before the RDR. Interestingly, not in this slide, profits, profit margins have not recovered, and profit margins are compressed compared to pre-RDR. The advisors are back. So as we can see here, with the RDR, advisor numbers dropped about 18%. What will happen in Australia? We've got a view on that. But the good news is that advisors are back, and we expect that they will surpass the 2009 levels. But they do wear different hats. This may inform the discussions in Australia. We see three hats that advisors might wear. The traditional high net worth advisor, independent financial advisor, IFA is what we would call them in Australia, where they have that best interest duty and required to broker the markets. Very successful business models there, high touch, high fee models there. Increasingly, we're seeing the aligned advisor providing restricted advice. And in the UK, we're seeing active vertical integration. So very different to what's happening here in Australia. The aligned advice could probably be likened to, excuse me, to the intra-fund advice models of the industry funds, and the single product provider where they broke the market, but they only do so in relation to a particular class of product. The next big idea I want to talk about, so we've talked about the experience of the UK, and we've taken a look at trust. The next idea I'd like to talk about is the dispersion of advisors and how we can make sense of that. So every year for the past more than 10 years, greater than a decade, we've done licensee research where we've spoken to advisors on what they think of their licensee and what their intentions are. Very clear message here from the most recent licensee research that advisors, if they haven't left the institutions, they're planning on leaving the institutions. They're not going to go to another institution. They're either going to self-license or they're going to what we call the new mid-tiered licensees. unaligned licensees. Here are these. Here are the intentions played out with a data point. How you read this slide, on the y-axis is the number of licensees, and on the x-axis the number of advisors. So the number of single advice licensees since 2014 has increased significantly. So there's been a great shift to self-licensing. And what we're also seeing here on the right side of the x-axis is the increase in the number of advisors in those mid-tier licensees. So what we're seeing playing out is people leaving the institutions, even before the institutions said that they were getting out of advice, self-licensing or shifting to the mid-tiers. And that's because, speaking frankly, they're miserable in the institution. So these are NPS scores. There's a lot to be said about NPS scores, but everyone understands them. So when you ask an advisor whether they would be willing to promote their licensee to another advisor, clearly the institutional, the advisors working within the institutional are deeply, deeply unhappy. And that's skewing the overall industry because the mid-tiers, the unaligned licensees are winning when it comes to Net Promoter Score and satisfaction. It's clear that let's just take a look at the orange section there. So looking back 3 years, when we asked the question, please rate the overall support provided by your group, you can see the rating has dropped overall. But when you look immediately left to the institutional branded, that's where the issues are. And when you look at the independents or unaligned or mid-tier, then they absolutely feel more supported. The last idea we're going to talk about, this is Napoleon Bonaparte, how we make sense of everything that is happening with the advice market. And that's interesting, right? That's interesting for advisors because they're looking to understand the characteristics of success for the future, but it's also interesting for licensees who are seeking to attract and retain the right type of advisor. And it's interesting for fund managers who are seeking to reach the right advisors at the right time. For the first time ever, fund managers have to become marketers and not business development managers. What's all this noise? All this noise about advisors leaving. This is a chart that we've taken from the ASIC Financial Advice Register, and it shows the significant increase in the number of advisors on the register towards the end of 2018. Is it the case that the advice industry is in fact growing? No, it's not. What's happening there is there was a deadline to get your advisors listed on the Financial Advice Register by Christmas 2018, the end of December 2018, or they would be considered a new entrant. And if they're a new entrant, as we just listened to Fasia talk about, the education standards are higher. So something to ponder, something to think about is we have a whole load of advisors who are not really advisors, who might potentially be advisors, placed on the Financial Advice Register in the expectation of them being able to take a shortcut and not try to meet the education standards. And is that really how a profession behaves? Now we're seeing the shakeout. So we have seen a 10% fall just from the Financial Advice Register from that previous high. Are they advisors who were never really advisors and were put on the list and now are being taken off? I'm sure there are some of those, but some of them would be advisors who are absolutely leaving the industry, and we expect that to continue to play out. About 6 months ago, CoreData segmented. We did a future of advice study, and we segmented the advice landscape practices actually, and financial advisors, the characteristics of financial advisors working within those practices. And we saw 4 behavioural segments. So at the top there we have foxes, and top right, oxen, and mixing our metaphors from animals to holidays. And down the bottom we have islanders and cruisers. Non-overlapping criteria around rate of pace and size. But what we see is about 20% of the market are what we call foxes. They're younger, generally age 35, on average age 35. Zero grandfathered investment commissions in those practices. They have business plans and they are ambitious and they're on the move. Their revenue may be low at the moment, but that is increasing. The oxen are multi-generational practices that are the foxes, but they're more mature in the business life cycle. Generally have partners who are older, probably maybe leaving the industry, and there's a tension between the younger and the older partners. The bottom right there are the cruisers, and there's a significant number, around a third, maybe more than a third of the practices out there are cruisers. So these are advisors working within practices that are riding out on previous activity. So they're heavily reliant on the grandfather commissions, and on average they have a third of their revenue coming from grandfather commissions. Some of these practices have more than 80% of their revenue coming from grandfather commissions, and when they are banned in about 12 months, if they haven't taken action, they'll be insolvent and certainly not profitable. Islanders, 7% of the market. They're the advisors working by themselves in the old way. There's a good chance that that 7% are within that 10% who left in the last 6 months, and they may already be gone. So overall, we expect that from the all-time highs, that about 42% of the market is in flux. Some of the oxen will leave. The practices won't leave. The advisors, the older advisors in those practices may leave, or they may get their heads around things and really embrace the future. But if the cruisers and the islanders don't embrace the future, they'll be gone. We see three practices of the future. The old way of working, how the cruisers and the islanders have been working. We've got some of these advisors in our building in Sydney, and I'm always amused to see financial planners in the interview rooms with a piece of paper, not using technology at all with their clients. They've got all these modelling tools at their fingertips, and they don't use them. The successful practices of the future will either specialise, move away from product execution, product selection, and move into professional diagnoses. They'll be very successful. If they get their pricing right, they don't need to embrace technology. They can just ride on their specialist expertise. The majority will corporatise, and we're already seeing this. Corporatising firms, investing in technology, embracing robo-advice, embracing digital, reducing their cost to serve, and creating SOAs. Without paraplanners, we're seeing lots of activity in that space. This third category of platform up businesses haven't resonated in Australia to date, but the obvious players there will be the super funds, industry and retail super funds who are getting out of traditional advice. The last thought I'd like to leave with you are two of these philosophical laws of community and laws of nature. And everyone's heard of Pareto Principle. It's the 80-20 rule. Probably studied that at school. And that is the idea that 20% of concerted activity gets 80% of the outcome. And it's a major driver of efficiency. If you spend your time on that 20%, you'll get 80% of the outcome. Price's law is different. And Price's law, once we talk about it, you'll see it over and over again. It started in academia, and basically the rule is the square root of the number of people working on a problem will get half of the outcomes. So if you've got 25 people working in your practice or business or firm, 5 of those people will get 50% of the outcomes. If you've got 36, 6 will get the 50% of the outcomes. If CoreData is right, if CoreData is correct in the fact that 40% of the advisors from the all-time high will leave the industry over the next few years, then we might have a situation where the population of advisors is only 16,500. They're dispersing, they're working in self-licensed channels, they're working with mid-tiers. How do we reach them? How do we reach the most effective square root of 16,500? If you apply Price's Law to the advice industry, there are only 128 planners out there in the ecosystem that are going to get half of the work done. So how do we reach them? And the answer is with data. So 4 big ideas. We've talked about trust, the fall of trust. We've talked about what's happened in the UK. The key message there is the sooner we get our heads around the new paradigm of fee for service, the more effective we will be making sense of the dispersion and the cry for freedom and the characteristics of the future. So thank you.